After I finished my service as a lone soldier in the Israeli army, I realized this was my defining moment. It's time for me to build success, create stories, and the financial freedom that I never had before. I used to be trapped with money, and now it empowers me. Since then, I've developed a multi-million-dollar financial advisory business, a podcast that has been featured on all the global media stations around the world. One of my favorite things to do is educate people on the mindset to build resilient wealth, build success, and have fun doing it. In my show, you will not only get best-of-class tips, amazing stories, a bunch of laughs, but you'll also get a mindset shift from a family of people who have come from nothing and will help you be ready to succeed. Welcome to the Resilient Riches Podcast. Have you ever thought about building a company from nothing? Have you ever thought about going into tech and you see all these people with these huge exits and you don't really understand exactly how they're doing it? Is the grass always greener on the other side? And is what we're doing not enough? So I thought, let's bring in the CEO, the former CEO of Meetup, Investopedia, and all these other amazing companies to talk about the biases and how can we break through and how can we see what actual is reality when it comes to building your wealth in tech, when it comes to building wealth, and how to create balance in your life that honestly people don't even know how to do. So David Siegel is a great example. I really hope you enjoy this episode. It's one of our greatest. Welcome, everybody, to another episode of Resilient Riches. I thought today, let's bring one of the generational greats in tech consulting, and really in tech just in general. So David Siegel was the former president of Seeking Alpha, Investopedia, and Meetup, who was actually that was owned by WeWork and sold for many times what it did, as well as nonprofit, podcast, father of a Chayil Boded, living now in Israel. And I thought, let's talk about specifically what it means to go into tech, how to build a tech company, how to sell a tech company, how to scale tech companies, and how to actually build wealth doing tech. So David, if you can give us a little intro, we got a lot of questions. We're going to go into it quickly. My dad doesn't know what tech, so he's still trying to figure out what is tech companies, but let's get right into your story.
Well, in Israel, they call it high tech, right? They don't call it tech, which is always funny. Like, why is high tech? Why not tech? And when you call me a generational leader, I guess that's just another word for saying I'm old, so I'll take it. Okay, so speaking of old, I started as a tech leader, as an early employee of DoubleClick back in the late 1990s, what's insane about that is that there's over 200 CEOs of tech companies that came from the early days of DoubleClick, which is quite an extraordinary number. After that, I worked as an executive for a bunch of big tech companies people have heard of, like 1-800-Flowers, et cetera. Then, as I said, I ran a couple of different businesses, Seeking Alpha, Meetup, 80 million users, Investopedia, and had 2 exits, sold them both, and seen a lot of ways in which I've made mistakes from a compensation standpoint, from a structuring financial standpoint, and happy to have people learn from failures and maybe from some successes too.
Let's go into the failures first. So what were the big things that you went in and you were like, hey, and you're typically, I find tech professionals pretty altruistic. So you went in, and what was the biggest failure that you had just right off the gate that you're like, this nobody else should do?
Okay, sure. Well, WeWork is a once in a generation type experience where you join a company that's a $47 billion valuation. It goes down to a $1 billion valuation. But I remember in my negotiations with my pay package, because Meetup was owned by WeWork, I was pushing really hard to have as much as my compensation be in WeWork equity, which of course ended up being worth absolutely nothing at the end. So being cognizant of that is pretty important. And you would think I would have learned my lesson when at DoubleClick 20 years prior, I had joined DoubleClick at the time in 1998. The stock was about 11, rose up to 250 in 1999. And by 2000, it was back down to 8. And I had put most of my 401k money in that. So you would think I would have learned from putting too much of an emphasis on company equity that you don't necessarily control.
I would say that's learned.
Yeah, exactly. So that was probably my biggest mistake, and the worst part about it is I repeated it 20 years later.
So okay, so let's actually dive a little bit into that. Why did you think that you should put all your equity and all your funds into the company that you're part of instead of diversifying, which is the general consensus?
Yeah. So back at the DoubleClick days, because I was an idiot 24-year-old, I didn't know anything. For WeWork, when I was a 47-year-old, I didn't put my 401k in at that particular time. It was more about thinking about my career and thinking about how I had a significant amount of money already saved up from a previous exit, it allowed me to be able to put more of an emphasis on upside rather than guaranteed compensation. So for example, before I had an exit in selling Investopedia, my entire focus was paying for yeshiva tuitions and paying for having a high enough salary as possible. And I was always willing to take less equity and higher salary because I needed short-term cash at that particular time. Once I had my first exit with Investopedia and we sold the company for close to $100 million, I then had enough of a safety valve that I was able to focus less on what my initial base compensation was. And I took a nice base compensation decrease in order to have more kind of upside later on. So,
Right. So
it was more a result of having had an exit already previously.
I find that super interesting. So the concept would be when you are building wealth, it's really, really great to have a lot of equity. But if you need the money today, you need to really make sure that you have a salary. So there's like a balancing act in like tech and really in a lot of places and in startups. How do you structure your income versus how do you structure your equity? What would be, let's say, a typical tech person's salary versus the equity, and where is the sweet spot? Like, how should people think about it?
Sure. It really depends on what role you're in. So if you are a total founder and you're starting a company, you're going and you just raised a seed investment, right? So you're the highest possible, most senior level, and you're very early maturation state in the company. You're going to take a very low salary. We're talking about like $80,000 a year or something like that to start. In fact, a founder that I'm advising right now, they have 5 people on their team that are making more than the founder, because oftentimes CEOs will take very low salaries in the beginning, but to hire people, you need to pay them market rates. As the company matures, in fact, as she's raising a Series A, her salary is going to be going from about $80,000 to about a couple $100,000, and that's because she's raising the money and she's able to do that. So stage of maturation is really important. Meetup was a company that had been around for 15 years prior to my joining. So there was no reason to take, a particularly low salary, but I told them that I would rather take a lower salary and have more upside, because first of all, it demonstrates to investors that you're really in it to win. And people like that kind of signaling. It's definitely very meaningful versus if you say, hey, I need to guarantee a certain amount of money and not as much of that. So that doesn't exactly drive a lot of confidence in a potential investor. And in terms of a role, the more junior the role, the higher, the salary will be more similar to what someone would get if they were not in a tech company, because they oftentimes will have very little to no upside or very minimal upside. So kind of that's the triage that you have to think through.
Gotcha. So the higher the level, the lower the salary, the more the equity. So you really are,
Correct.
everybody is playing that balancing game. So let's talk about raising capital. So I come into a company, I have an idea. Should I go out and raise capital right away? When should I raise capital? What are the hurdles to raise capital? And why do I need capital?
Okay. A lot of questions there. So first, there's a misunderstanding around capital raising, which is people usually pound their chests and say, whoa, check me out. I'm so great. I just raised 5 million, 10 million, 20 million. The goal is not to raise the greatest amount of capital and then lose a tremendous amount of money for your investors. The goal is to raise the right amount of capital at that time, because the more capital you raise, the less ownership you have in your company, the more you dilute your investment, and the more dangerous it is to ultimately how much of money you're going to have at the end. A buddy of mine sold his company for a couple $100 million, and he had raised so much capital, he owned less than 1% of the company at the end after running the company for 20 years. That's a dangerous situation to be in. So the goal is not maximally raising capital. The goal is actually raise as little capital as you need in order to get to the next tranche of capital investment where you will have a higher valuation. Would you rather raise capital at a 3 million valuation or a 30 million valuation? The answer is 30, or 300 million valuation. So you want to raise as little as you can in the beginning when you only have a very low valuation, and as much as you can later on when you have a higher one. So the goal isn't maximally raising capital. It's raising the smallest amount you need to get to the next raise, which is usually somewhere between 9 and 18 months later.
Gotcha. And why are people raising capital? Like, what is the purpose for raising capital? Like, wouldn't you focus when you're building your business to make it profitable so you don't have to continuously raise and you could do it organically?
Usually not. It's very rare, extremely rare, that a company can be a profitable business right from the start and also be a high growth business. Specifically, company valuations are based on growth rates. Your multiple that you're going to get to your revenue or to your EBITDA, your profit, is going to be based on how fast you're growing. So if you're growing at a very fast clip, then you could get a 10x multiple to revenue, let's say. If you're going at a very slow clip, it could be a 1x multiple or 2x multiple to revenue. So the way in which you have outsized revenue growth is usually investment, marketing investment, salespeople investment, etc. So it's usually more worth it to raise capital in the beginning, to hire salespeople, to invest money in marketing, to grow faster. And by having a faster growth rate, you have a higher valuation of your company. By having a higher valuation of your company, you are then able to obviously monetize your hard work, and you're perfectly happy to have, let's say, given up 50% of your company if your company is worth $100 million, than to petering around and have your company be worth $5 million but have 90% of it.
So let's say, all right, I raised the capital, I'm building my wealth, I'm starting to grow, and we're growing really, really quickly, and now I'm thinking about exiting. What are the mistakes that you've made for pre-exiting, and what are the successes, I would say? Sorry, what are the mistakes you made pre-exiting? What are the successes you made post-exiting? And what would you give people to say, okay, go exit or go public? These are the two questions.
Yeah. Okay, so going public is not a likely scenario for most people. So take that out of the equation. You need to be doing, and people are like, I want to go public. Great. You need to be doing like hundreds of millions of dollars in revenue to actually be able to be a publicly traded company in the US, that is. You want to go public in Azerbaijan, you could probably do a lot less revenue, but most people don't want to do that. Let me tell you some best practices first. So best practice number one is a strong business development and great partnerships leads to a corporate development and M&A opportunity. So what do I mean by that? When Meetup was looking to get sold, I didn't just reach out to people for the first conversation to say, buy us. Like, that's not a path to getting acquired. A great path to getting acquired is to have pre-existing relationships for multiple years where people trust you, they like you, they believe that there's a bigger relationship there. So I built relationships with the CEO of Starbucks. I built relationships with the CEO of Match.com, and a whole bunch of different companies. Once you have already a pre-existing partnership in place, it's much easier than go to them and they're like, hey, we've been approached by another strategic buyer to potentially acquire us. If that's something you'd be interested in doing, then let us know. So you don't want your first conversation to ever be about an acquisition. It should always ideally be a pre-existing relationship and partnership. Super important. Meaning you start the sale process many years before you actually want to sell the company. You start the sale process with building relationships, trusted relationships. That's kind of advice number one. Advice two, in terms of selling a company, understanding the landscape of who the buyers are is very important. There's two types of buyers. There's strategic buyers, which are companies, and there's financial buyers, who could be private equity firms, could be venture capital firms, could be investment houses, whatever. It almost always is better to be acquired by a strategic, meaning another company that does some similar things to what you do, versus being acquired by a private equity firm. Private equity firms buy you in order to usually reduce your costs, fire lots of people, and then resell you. It's much better to not have to go through that interim step, but get all that value ideally, for yourself. When you go for sale, and the best thing to do is to create multiple bids, obviously. So you want to talk to as many different potential buyers as possible. Meetup, we probably reached out to over 100 different potential buyers. We ended up getting 8 different offers to acquire us. We were able to leverage those offers against each other, which obviously works extremely well in creating a competitive type situation. And ultimately, the best is when someone actually reaches out to you to acquire you. That is how people get outsized sales of a company. So meaning someone says, hey, have you ever thought about, joining forces with us or being part of a larger company? And your answer is, well, we're really not for sale. Even if you are for sale, the answer is always, we're really not for sale. Selling, M&A, it's all just like dating. People, Groucho Marx line of, what was the line, is something to the effect of, I only wanted to be a part of a club that wouldn't accept me as a member. Some version of that, which is people only people want what they can't have, just like in dating. Same thing with companies.
Gotcha. So let's talk about, you come into a liquidity event after your first sale. What was the now all of a sudden you're rich, and you probably like shouted on the rooftop, like, I'm rich, everybody, nobody talk to me anymore. Like, what was that experience like? And what did you do with your money after you actually came into money? Did you immediately reinvest in a new company? What did you do?
Definitely no shouting, that's for sure. Listen, after selling Investopedia, I didn't change my lifestyle at all, like zero. I think it's dangerous to do so. And even after selling Meetup, which was a much bigger exit that allows me to not have to work anymore, I didn't buy anything of significance. I think it's important to try to live within your means and to figure out what you're passionate about. And what I believe money is not about money. Money gives you the ability to have freedom and to focus on those things that are really important to you. So that's what I did. I'd rather take money and then start a nonprofit, which is one of the things that I did. I'd rather put more of my time to philanthropic ideas, to mentoring people, which is what I've been doing. Maybe investing in some companies, which is also what I've been doing. But to me, all it does is it gives you the ability to own your time more effectively versus having other people own your time. And it's just a means to an end. It's hardly an end to itself.
Yeah, I find a lot of people, after they sell, they get really depressed and they're not able to reinvent themselves. So they'll work 35 years, and then all of a sudden they sell, and all they did was work. They never taught their kids how to ride a bike, to swim, or anything like that. They sell, and now all of a sudden they're like trying to catch up on life. And it's really, I find they get really depressed. It's kind of like what happens with football players or people who win the lottery. I find it really similar in that capacity. How would you speak to those people? Like, what advice could you give them?
Yeah,
Because obviously you went through it.
Yeah, well, there's been many studies of lottery winners whose levels of happiness is much lower multiple years after they won a lottery than before. So that's a fascinating piece of data that Yair, you referenced over there. Listen, like Maimonides or others or Aristotle have said, the golden mean and living a life of balance is super important. When you hear about people that need to work till they're 80 or whatever plus years old because they don't have any hobbies, they don't have any interests, I feel sad oftentimes for those individuals. I think the world is an amazing place. The people are amazing. The people's ability to reinvent themselves and to do different things than they've done in the past is extraordinary. And I think, people get very closed-minded and focused on just one thing, and they forget their family, they forget their friends, they forget their passions, they forget the things that they used to do. They forget what it's like to be a child and to have wonder and curiosity. And it's unfortunate. I think for me, my dad worked really long hours as starting. He was an entrepreneur neurologist. He started a big neurology practice, became the biggest practice in the state of Connecticut. I had 40 people working for him, and I did not want that. So, I've traveled to 65 countries. I do triathlons. I really love getting as many different life experiences throughout my entire life. And And that's what made, quote unquote, selling my company very easy, because I just have an incredible diversity of different love of knowledge and experiences. And it's beautiful. And I'm very blessed for that. And I think that others, and I'm not special, I just prioritize it more than other people. And I think that the more that people can understand that money is simply a means towards becoming the best person that you could possibly be, the better. For me, it was really easy, like really, really, really easy. I sold my company 2 years ago, and I'm busier now than I've ever been, but I'm busy with things that I just love doing. I mean, today I went to, a Torah class in the morning. Then I went bike riding for 3 hours. Then I advised one CEO about how to change the strategy of the company. Then I met with another CEO on how to go about raising money. And now I'm talking to you guys, and I'm going to dinner later on. So my day is filled with, lots of different experiences, and it's really a blessing.
Yeah, I think keeping that. Last question. Would you recommend people to follow the path that you did and go into the tech space?
The tech world is a phenomenal place to work, full stop. Many people that are physicians, as medicine gets more socialized, it's harder to earn the kind of incomes that people would earn a generation ago, unless you have a very specific specialty in certain areas like dermatology or what have you. Being a lawyer, I know many, many, many unhappy lawyers, incredible numbers of people that are working all hours of the night and constantly feel tremendous stress. In tech, it's such a growing field. You can have an incredible balance of life. Every day looks potentially different. If you want to live in Israel or a different country, you can. If you want to work from your home, you can. If you want to travel to different cities, you can. I am so lucky that I ended up in the field that I was in, and many people get stuck as a trained accountant, and they may not love accounting, and that's what they end up having to do. Tech is so broad. You could do so many different things, and I haven't looked back, and opportunities are voluminous. Especially if you're an engineer, you're in demand. And when you're in a job that you're in high demand, you can have a greater opportunity to dictate the terms, versus if you're in a job with low demand and high supply, and then you're in a much worse position from a career standpoint. So I'm very, very lucky to have pursued what I'm doing. And I definitely encourage others, to realize that if they think that that's something that's meaningful and enjoyable for them.
Gotcha. David K., jump on in here.
That's me. So it's nice to meet you. I find a very fascinating story, David. But I would say your biggest success is achieving that balance of life and the quality of life that you're able to maintain now. I have a neighbor down the street, and he made a lot of money, but his kids hate him. Like, now that he's sort of semi-retired, whatever, and he's trying to make it up to him, it's something you could never really make up. And one of the areas that we always stress was, try to find the area in life that you're passionate about, and that's where you should concentrate. And it's not worth it otherwise. But just some of the areas that you talked about, to some of the notes that I took, is pretty interesting. I find, like, at the beginning, like, it sounds like the trade-off between risk and return. So the lower salary you would take, that would be giving you your higher potential return down the road, like having more equity in WeWork and taking the lower salary. I mean, that's really your trade-off, and that's what we say about investing too. The life is like that. The higher risk, the higher return. So that sounds like that. As a broad policy, that's what you've applied.
Absolutely. Listen, I'm not like, buying only iBit and Bitcoin and Ethereum right now, but I'm much more apt to buy those things from a career standpoint when you have a safety net that you're more secure around. Then you could be more risk taking. And the less of a safety net that you have, the more risk that you have to take, but then potentially the higher return. I mean, tech, I think being in tech is, the opportunity for high upside with minimal risk, actually, for the last question that was asked, because there's always going to be demand for people in our field. And therefore there's less risk, but there's super high upside, unlike many other roles where there's not as high upside. In terms of what you mentioned originally, listen, investing in your children, your family is the most important investment you can make, full stop. And it's not something you could just like wake up one day at, 75 years old and realize you're going to do it. One of the priorities for me, for example, I wrote about in my book called Decide and Conquer was when Meetup was about in the most intense part of the sales process. But my son, who's a huge Green Bay Packers fan, we had planned to go for the weekend to a Green Bay Packers game and fly out there and to Milwaukee and then to head off to Green Bay, and just got to prioritize it. So like I took my kids on one-on-one vacations, all the time. I never had a time where I wasn't taking 1 or 2 or 3 family vacations during the year. Those things are way, way, way more important than anything else. And, it is about spending time together. You have to spend time together. And travel is a disenabler. It's important, but find ways of taking your kid on travel. And I used to do that all the time. And they'd hear me speak in Madrid and other cities. And it was also a lot of fun.
That's interesting. So I'll just finish off with this. I had a friend of mine that was in yeshiva. He actually started Sirius satellite radio. So I saw what he went through, and obviously they went public, but it's like, it was a very stressful time. Like especially when you're in that initial phases, when you're raising money and you're trying to balance the valuation with what you're trying to get from the investors, which I find very, very super interesting. But it seems like that's a very stressful time, especially at the beginning. You haven't proven yourself, and yet your investors are calling you occasionally or whatever they're doing to find out what's going on.
Yeah, listen, it's okay to have very stressful times. I've had many of them for short spurts. So I've had times where I'm working insane hours for 2 or 3 month time period because we just launched a major product, or we just acquired a company and need to integrate that company, or whatever it is. What's not okay is for your entire career to be this intensity all the time. That's not healthy. It's not healthy, and it's not balanced. So having certain spurts of 2 to 3 month time, where that once this thing ends, you're going to be able to get back to normal life. It's just how things work. You just have to know that there's a timeline.
I think that's your superpower, because a lot of people say, yeah, you tell your wife after 3 months, yeah, I'm going to go back to normal, and then they don't. But I think your superpower.
Right. Well, it's because if they say we're going to go back to normal and they don't have a good reason for why they're going to go back to normal, then they won't. If they say I'm purposely working a crazy amount right now because of this external event that just happened to have happened that we're in the middle of, and it's going to end at this time, great. If they say, I know I'm working really hard right now, but I'm going to slow down later on, and there's nothing between before and after, then of course they're not going to. It's just a mindset of like, what's your priority? And hopefully most people's priorities are much more family than just like, making more money.
That a lot of people say it's family, but it doesn't end up being.
Yeah, of course. It's unfortunate. I mean, listen, the famous thing on your deathbed, no one says like, I wish I worked harder in my job. It just doesn't happen.
Right.
So David, can you give us your shameful plug? Tell us a little bit about your book. Tell people how they can connect with you. Where can people find you?
Okay. Well, I'm very active on LinkedIn, put it lightly. And you can find me through that. Sure. Feel free to send me an invite, and you can see what I tend to post about, whether it's startup stuff or whether it's stuff about Israel. Outside of that, you wrote a book called Decide and Conquer, which is all about kind of the biases that people have in making decisions, how to avoid those biases, whether it's confirmation bias or recency bias, to make smarter decisions as kind of business and startup leaders. So if you want to, you can check that out. And I had a podcast called Keep Connected, which is about the power of community and how to end kind of loneliness epidemic, that exists in the world. So
Love it.
yeah, look me up. Feel free.
David, thank you so much for the insight. Thanks for your honesty. We really appreciate you coming on. This podcast is provided for informational and educational purposes only, is not intended as investment, legal, or tax advice. The discussion is general in nature and does not take into account the specific financial situation, objectives, or needs of any individual listening. Nothing discussed should be construed as a recommendation or solicitation to buy or sell any security or to engage in any particular investment strategy. All investments involve risk, including the potential loss of principal, and there is no guarantee that any strategy or approach discussed will be successful. Any references to experience or outcomes of the guest are not indicative of the future results and should not be viewed as representative of all investors or entrepreneurs. Investment advisory services are offered through the Klyman Financial, a DBA of the Partners Wealth Management, an SEC-registered investment advisor. Registration does not imply a certain level of skill or risk or training.